happen?
Well, there are a number of things that have happened. Certainly, since the beginning of the year, Cyprus happened, and that has thrown more uncertainty into the cycle. And the other thing that's happened is that financial assets in general, across many asset classes, have really been on a tear. Everything, valuation is up in many areas. Equity markets have been very, very high. Many regulators have cited their concerns about the high yield and leverage markets. And I think there's a general feeling that things don't have that much further to go.
Now, I want to ask you about defaults because the outlook is still negative, but it looks like it's getting better. Why you think that could change, actually, despite what the survey says? So what do you see going on there?
Well, I think there's a lot of good news already taken into account into people's predictions. And there's certainly a feeling that if there's anything that goes awry, things could fall apart very, very quickly. And I think the markets in general are reacting to a lot of these unexpected news items with a lot of alarm. I mean, just a couple of days ago, you saw the report from China. They had very, very good growth, but just a bit lower than expected. And equity markets tumbled, gold tumbled. Lots of things were going haywire as a result. Things have since bounced back. But I think that's a reflection of the uncertainty in the market. So any little thing can really kind of shift things off this not too warm, not too cold prediction of the future that we've been on. And I think there's a lot of uncertainty out there that could knock things off the current track.
Although it's interesting because it seems like within the Fed, some of the comments as of late talk about ending the bond buying program maybe sooner rather than later. So it's interesting that the markets are looking at some of these negative factors and really thinking the worst about economic growth, or thinking less positive, if you will.
Well, it's not yet negative. It's really plateau, I guess. There's most people in the survey predicted things are going to be unchanged. There's some who think it's going to get better, some who get worse, but actually those numbers balance out almost completely. So there's a majority who think things are going to be unchanged, and there's a bit of uncertainty around the margins, which I think really describes where we're at right now very well. We've hit a fairly high valuation level across many asset classes, especially credit asset classes. And we have some uncertainty around that, so if there are any surprises in the marketplace, things could certainly change very quickly.
You say we might be, in fact, in the fourth quarter of the bull market. So what do you mean by that?
Well, as I said, the asset valuations across many classes have gone very, very high. And one of the things we've been focusing on, certainly our members have been focusing on, is high yield market and leveraged loan markets. That's looking at very, very high levels with spreads extremely thin, and also structures getting back to some things that happened pre-crisis. Loans that were lighter on covenants and structures that are much more favorable to borrowers and much less favorable to lenders. And I think that's a sign of lots of cash chasing yield in these markets. And certainly central bank action has an effect on all of that. And any significant change in central bank policy will throw us off the track that we're on.